simplifying the 199A deduction for small business owners and what you should know as a small business owner. Who doesn't know that running a small business comes with many challenges, and that one of the biggest challenges is managing taxes? The 199A deduction, also known as the pass-through deduction, offers a valuable tax break for many small business owners. Yet, the rules can seem complicated and confusing. This post breaks down the 199A deduction into simple terms, explains recent improvements, and shows how you can benefit from it. First, what is the pass-through deduction? The pass-through deduction applies to businesses like sole proprietorships, partnerships, and S corporations. These businesses don't pay taxes directly. Instead, their profits pass through to the owner's personal tax returns. Owners then pay taxes on their net income. The 199A deduction lets these owners deduct up to 20% of their qualified business income, also referred to as QBI, from their taxable income. This deduction can significantly reduce the amount of tax owed, making it easier to keep more of the money your business earns. Understanding qualified business income, QBI, is essential. Qualified business income is the net amount of income your business generates from its operations. It excludes certain types of income like capital gains, dividends, and interest income. The 199A deduction is based on this QBI figure. For example, if your business earns $100,000 in QBI, you could potentially deduct up to $20,000 on your personal tax return, lowering your taxable income. Here are the key improvements to Section 199A. Recent changes to Section 199A have made the deduction more accessible and beneficial for small business owners. Here are the main updates. Increased phase-out thresholds. The income levels at which the deduction starts to phase out have been raised. This means more business owners can qualify for the full deduction before it begins to reduce. If your business has at least $1,000 of active QBI, you are guaranteed a minimum deduction of $400. This helps small businesses with lower income still receive some tax relief. Starting in 2026, the minimum deduction and income limits will adjust for inflation. This keeps the deduction relevant as the cost of living rises. These improvements make the 199A deduction more inclusive and supportive of small business owners at different income levels. How to calculate your 199A deduction. Determine your qualified business income, QBI. Find your net business income after expenses. Check your taxable income. Your total taxable income affects how much of the deduction you can claim. Apply the 20% deduction rate, multiply your QBI by 20% to find the potential deduction. Consider income limits and phase-outs. If your income is above certain thresholds, the deduction may reduce or phase out. There is a minimum deduction guarantee. Basically, if you have at least $1,000 in active QBI, you get a minimum $400 deduction. Here is an example. Sarah owns a sole proprietorship with $50,000 in QBI. Her taxable income is below the phase-out threshold. She can deduct 20% of $50,000, which is $10,000, reducing her taxable income by that amount. If Sarah's income was higher and above the threshold, the deduction might be smaller due to phase-out rules. Practical tips for small business owners. Keep accurate records. Track your business income and expenses carefully to calculate QBI correctly. Don't forget to consult with your tax professional. Tax laws can be complex. A professional can help you maximize your deduction and avoid mistakes. Plan and prepare for income changes. Since the deduction phases out at higher incomes, consider strategies to manage your taxable income. Don't forget to follow and subscribe to stay updated on all tax law changes. The 199A deduction rules may change. Let us keep you informed to take full advantage. Common questions about the 199A deduction. Can all small business owners claim the 199A deduction? Most owners of pass-through businesses qualify, but some service businesses face limitations if their income is above certain levels. Does the deduction reduce self-employment tax? No, the 199A deduction lowers income tax but does not affect self-employment tax. Is the deduction automatic? No, you must calculate and claim it on your tax return, so make sure if you don't do your own taxes, you use someone who will know how to do this. Final thoughts on the 199A deduction. The 199A deduction offers a valuable tax break for many small business owners. Recent improvements have made it easier to qualify and increase the benefits for those with lower income. Understanding how the deduction works And keeping good records can help you save money on taxes. If you run a sole proprietorship, partnership, or S corporation, take time to explore how the 199A deduction applies to you. Use this knowledge to keep more of your hard-earned income and support your business growth.